Okay. So we have the leadership slide here. Again, it just shows who they are and what their title is. I would love to have seen little notes underneath it, years of experience, where they worked before, what their education background was. So again, and what you need to be able to do too when you're making the presentation is articulate to me, what are their leadership styles? And what type of culture are they trying to build within the company? Because these people are going to be role models. They're going to be models for other people within the firm. And their ability to communicate and to lead in a charismatic way is extremely important for people to follow. Okay? You have to be charismatic. You have to be articulate. You have to have experience. You have to have certain types of referent and expert power. You got to be charismatic. You got to be able to articulate and communicate the overall vision of the firm and its culture. It's extremely important. Who's the competition? And again, here's your peer group right here. JP, this is by assets. Okay. JP, B of A, Citi, Wells, Goldman, Morgan Stanley. So when you're doing the ratio analysis, if you can't get an industry, a peer group ratio, you're going to have to calculate it. So if you have the ROE or debt to total market cap or whatever, what you can do is you can take these assets, sum them up, divide them back, now you got the weights. You got the ratios, multiply the weights by the ratios to get a weighted average, you now have the peer group. So I would do it by assets. Or if assets are, looks like these two guys dominate, so it's going to be, mostly their ratios. You might want to use earnings, but I would just do assets just so that you can learn how to do a weighted average of the ratios for a peer group, because they're not going to give you that pretty much any place, so you're going to have to kind of calculate it. It's a little bit more work, but it's more accurate. Okay. And you can see that Goldman wasn't even up there. Why wasn't Goldman up there? Because Goldman's not like those others. That's why we're doing the analysis between JP and Goldman, so you can see the difference. You got the SWOT analysis, and be careful when you're doing the SWOT analysis. A lot of people just use the SWOT analysis that's available within the reports. You can do that, but think about it and maybe add some stuff that's not in the research. Okay, again, you're the analysts. I need you to be thinking. Okay, I pay you to think, not to take somebody else's research and regurgitate it. Okay, here's the financial conditions. Very simple presentation. I really like the way that this is set up, because we have the financial ratios, we got B of A, and in this case it's going to be Goldman, then JP Morgan. Then when you do JP Morgan, you're just going to swap it, the analysis. You got all the data. Once you do it once, you're done. You just need to swap it out. And they did a very nice job of formatting here. It's all consistent. It's all 1 decimal, not 4 decimals. And then you can see the conditions. So they're comparing B of A to the peers in the industry and coming up with below average, average, below average, average, below average, and overall financial condition below average. They have it bolded. It's easy to read. Just some key ratios. They have some other key ratios. They have the equity ratios and the growth rates. Again, coding it, doing the analysis, coming up with average to good. Excellent, good, above average, average, below average, poor. That's kind of your categories, so you're going to have to be consistent amongst the categories. But this allows you to basically very quickly come up with the overall financial condition of the firm, which basically is the underlying fundamental that's going to support your recommendations. Perpetuity model. Again, I think she did a really nice job. Set out the risk-free rate, you have the beta, market return, expected return on equity. So that becomes one discount rate, right? So you could use 12, 11, 10, 9, 8 if you wanted to do sensitivity analysis. She had earnings per share. She could have had EBIT, EBITDA per share if she wanted to. She had earnings per share. She had 2014 projected. You're going to be using 2015 or 16 projected. I'd go further out. She has the return on equity sensitivities. She did 13, 11, and 9 as the sensitivities. The stock values at the range, pick the medium, boom. Her stock price valuation was 10 and the current stock price was here. So in this case, this would be, this would say that the firm is undervalued, or the current stock price is fully valued. Again, you may have different assumptions, plus the risk-free rate. Again, I would be careful with that. 30-year treasury is what, 2 point something. 10-year treasury now is 1.8. Historical lows, would you really be using historical lows? I don't know, you're gonna have to think about it. Beta, 1.8, that seems a little high. But again, conservative. Market return, 7%. I actually think that, when you look at the long-term average for the S&P 500, it's probably around 8 or 10. And then she looked at the history and then did the projection. So I thought that was a pretty good setup, very simple, not confusing, easy to present. Gordon Growth, again, basically used the same thing. It had the growth rate assumptions along the top, had the discount rates, along the y-axis. She had basically the pricing matrix here, high, medium, low. Pick the middle point for ease. Undervalued compared to the current stock price. So this was indicating that B of A, again, overvalued. I like that model. The multiple model, you got your growth rates. She calculated the multiples. She looked at historical multiples. I'd be looking at the peer group multiple too, coming up with some kind of forward-looking multiple to be able to apply. Again, she had the multiples here, the value, the ranges, boom. Looks like using the multiple approach, looks like the stock price is undervalued compared to the current. Again, clean, one slide DCF model. She's got the historical, terminal value, G, she actually used that. She calculated the weighted average cost of capital. Again, a WACC of 7.17, I don't know, it seems a little low to me, but, again, you're going to be doing sensitivities. She's got the WACC formula. Here's the WACC ranges. 5, probably unlikely. 7.17 calculated. She went up to 9 to do a conservative approach. At a WACC of 7.17 plus her growth rate assumptions, and actually I think she used different growth rates here, and then obviously a different growth rate for to calculate the terminal. But she came up with $26. Again, higher than the current stock price. So then, and this is I think really good on her part. I'm recording. She did a really good job here in summarizing it. And this is really key because she has the different valuation methodologies, the different stock prices, the valuations that she came from the different methodologies, and then she did different weighting scenarios. To weight, because these two, the multiple and the DCF, are probably more accurate. The multiple is used more by the industry. DCF is used by industry, less so for the Gordon Growth and the perpetuity. But again, I think you have to understand to really, to do the analysis right, you gotta look at all of them, because there's information in all of them. You have to determine which valuations you're gonna use, and then you do different weighting scenarios on the models to come up with the sensitivities, to come up with the different valuations, and she picked this one. 55% DCF, 20% multiple, 15 for Gordon, and then 10% for perpetuity. And she came up with a $22.01 intrinsic valuation using the weighted average approach. Greater than the current stock price, she came up with a buy recommendation. Not only to buy, but also provided the trades. Buy the calls, write the puts, buy on margin, buy ETFs, financial services ETFs. So I think she did a really good job. Put another matrix in the back, again for supplemental information, just really clean, really simple. And then just kind of summarized everything with a summary slide. Put some references in there where she got the data, which is key, and that's the presentation. So if you can